So all the eyes are on Uber and Lyft ahead of the earnings. I mean, these are big announcements, right in the middle of the pandemic. Top analysts are looking at this very, very closely. So earnings season is in full swing, and investors are busy parsing the reports to pinpoint compelling investments. So far, with about half of the earnings reports in, net earnings are down between 15 to 16% year over year. Sales growth figures are some 0.5% worse than had been expected. It's difficult to compare actual results to company guidance figures, as a large number of companies had rescinded guidance before earnings season began. But one thing is for sure, these results indicate the worst drop in corporate profits since 2009, right? And I don't think we're still even getting the full picture here. We're just getting like a glimpse of what's going on. But there may be some bright spots. Five-star analyst with Canaccord said he's released an earnings preview note and points out two ride-hailing giants that may have some positive news to report. We ran the 2 through tip ranks database to get the analyst community's take on them. It turns out that each of these stocks has earned the street's approval with strong buy consensus ratings. I tend to disagree with that, which are based on all of the calls issued in the last 3 months. It also doesn't hurt that each one has over 50% upside potential. Let's take a closer look. So Uber Technologies, Uber is scheduled to report earnings tomorrow, and consensus estimates are now seeing a drop to 89% per share loss for the leader in the rideshare app niche. That would mark a 39% deeper loss sequentially from fourth quarter, when Uber reported a 64-cent per share loss. Like other companies in the rideshare niche, Uber has worked to diversify its offerings. Peer-to-peer ride-sharing, scooters, and electric bikes have all been offered in various ways and locations. But the most relevant Uber diversification story for the age of Corona is Uber Eats, a food delivery service. With so many people locked down at home, food delivery service is in high demand. Uber Eats operates as a subsidiary company of Uber and has seen a spike in customer signups during the COVID-19 pandemic on the order of 30%. Graham points to the shelter-in-place orders as the biggest factor impacting Uber's performance right now. He notes the predictable results. Rides bookings are down, showing only 2.6% year-on-year growth, a far cry from Uber's initial gangbusters entry into the market, while Eats is showing quarterly growth on the order of 40% year over year. People must eat, and any company positioned to cater to that need will find a path forward. Summing this up, Graham says Uber has provided several updates on the impact of COVID-19 and is on its business since the pandemic began. In mid-March, the company confirmed that COVID-19 had significantly impacted the rides business, that markets impacted early on have also recovered quickly, and that Eats was performing solidly in the current environment. Uber also provided a liquidity update reminding investors of the strength of its balance sheet and the highly variable nature of its cost structure. Graham rates Uber stock as a buy with a $48 price target pointing toward a robust 77% share appreciation this year. Overall, Uber shares hold a strong buy rating from the analyst consensus, with no fewer than 29 recent reviewers chiming in. The breakdown is 26 buy ratings with only 2 holds and 1 sell. The stock's current trading price is $27, while the $41.64 average price target suggests it has room for a 53% upside potential. I unfortunately do not agree with that, but that's their opinion. We shall see what happens tomorrow. Your comments are welcome.